Hi, and welcome to another segment of Tax and Business Matters. I'm your host, May Watson. Let us continue with the last segment on the most overlooked tax deductions. Alright, let's start. Number 17 on our list of the most overlooked tax deduction is additional bonus depreciation. As part of the year-end law extending the Bush tax cuts, 50% first-year bonus depreciation was extended and expanded retroactively to let filers write off 100% of the cost of qualified assets placed in service between September 9, 2010 and December 31, 2011. In effect, filers get to claim unlimited expensing. This break applies only to new assets with recovery periods of 20 years or less, such as computers, machinery, equipment, land improvements and farm buildings. So don't miss out on this big tax benefit if you placed business assets in service late in 2010. Number 18, break on the sale of demutualized stock. We're talking about stock that a life insurance policyholder receives. When an insurer switches from being a mutual company owned by policyholders to a stock company owned by stockholders, the IRS's long-standing position is that such stock has no tax basis, so that when the shares are sold, the taxpayer owes tax on 100% of the proceeds of the sale. But after a long legal struggle, a federal court ruled that the IRS is wrong. The court didn't say what the basis of the stock is, but many experts think it's whatever the shares were worth when they were distributed to policyholders. If you sold stock in 2010 that you received in a demutualization, be sure to claim a basis to hold down your tax bill. Number 19. Homebuyer credit. I put this last because it's hard to imagine any taxpayer missing this big a tax break. First-time home buyers and long-time homeowners qualify for this break in 2010 as long as they either closed a home sale by April 30, 2010, or entered into a binding contract to purchase a home by April 30 and closed on the deal no later than September 30. The credit is $8,000 for first-time home buyers, someone who didn't own a home in the 3 years leading up to the purchase of a new home, and $6,500 for long-time homeowners, those who continuously owned a home for at least 5 of the 8 years leading up to the purchase of a. The credit gradually disappears and is phased out for taxpayers with adjusted gross incomes between $125,000 and $145,000 for singles, and $225,000 and $245,000 for married couples who file jointly. Also, if you purchased a home in 2010 and want your credit quicker, you are allowed to claim it early by filing an amended 2009 tax return. That's about it for today's Tax and Business Matters. Thank you for watching this last segment for the series of shows on the most overlooked tax deductions. In the next episode of Tax and Business Matters, we will tackle the 10 tax mistakes parents often make. I hope that you will join me again next time, as we continually learn how to cut our tax bill to the bone. You can visit us online at www.howtodoyourowntaxes.com. Once again, this is May Watson, saying, your aspirations are your possibilities. Till next time, goodbye for now.